Hi everyone, welcome to the first episode of the Explain This Stock YouTube show. I'm Aziz, and this week is American Thanksgiving week. And a lot of you will be doing some shopping, so I thought we could do a deep dive analysis into a relevant company, Instacart. There aren't a lot of analysis out there on Instacart, and one of the reasons might be that it's a relatively newcomers to the public market. Their IPO was on September 2023, and over the past year, there has been a lot of interesting development in their business. So in today's video, I'll walk you through my thesis on Instacart's business, their strengths, their financial health, their leadership strategies, and their risks. We'll use Explain This Stock platform to do all of that. And if you like this platform, feel free to check it out on explainthisstock.com. So let's get started. All right, so the first thing, let's run a quick search on either here on the search bar or if you have it already on your watch list. And let's get started with what does Instacart do, right? So Instacart is as it is described here, a grocery shopping service to people in North America. They connect consumers with a personal shopper. In this case, it can be either a shopper in the grocery store or a driver, and deliver a range of products. Groceries, pet care, any type of product. It really depends on where are you shopping, essentially. It's categorized in the NASDAQ as a specialty retail industry, but to me, it's really not. If you had to compare it to other businesses, is closer to a DoorDash rather than a Walmart. They don't operate their own fulfillment centers yet. They don't store any items from their store partners. They don't store any produce, but instead they deliver them to their customers. That being said, I do believe that at some point in their life cycle, they will own their fulfillment centers that their partner could store items in for a fee, just like what Amazon does with their fulfillment center. And this will be particularly interesting for their partners to expand in locations where they don't have a presence at a minimal capex cost. They don't do that yet, but I suspect that this is something that they will do in the future. Operationally speaking, if you like to understand what Instacart does, essentially there are three main actors in their ecosystem. There are users, just like you and I. They have drivers, or they call them shoppers, and they have grocery partners. You can think of any other business because they are expanding with restaurants as well, not just grocery partners. In this ecosystem, what's very interesting at Instacart is they're able to actually double dip. They're able to make money by charging users as well as charging grocery partners. So users are charged via subscription fees, and in some cases via delivery fees and via surcharges on items. Whereas partners pay them via contracts, so they pay a fee for being listed on the application, as well as they pay them by spending ad budget. Because Instacart recently entered the space of advertising. So grocery stores and any business could actually start spending ad budget on Instacart. It's not explicit whether Instacart does print some of these ads outside of Instacart, but they might as well be printing them anywhere on the internet. I haven't personally come across any ad from Instacart outside of Instacart, but if you have, let me know in the comments. Instacart, as a matter of fact, counts a lot of big names among their partners. Some of them are Kroger, that publicly accepted to be listed, Costco, Uber Eats, and they are actually starting to test a new product called Caper Carts, and they're testing them in a couple of locations. If you've come across these carts, let me know in the comments. I'd love to know where are they testing them. But if you're not familiar with Caper Carts, let's look at what they advertise on their platform. So this is essentially a smart cart, right? It's a cart that's supercharged with a lot of high tech, right? It has a way to determine what are you placing in the cart, the weight of what you're placing, and identifying what are the items that you're putting in your cart. It's a very fancy shopping cart, essentially. And the strategy is quite simple here for Instacart. They're capitalizing on the fact that their systems are already well connected with their partners' inventory systems. So they're trying to upsell their partners by selling them these carts so that their visitors, their users that are visiting their stores, continue to use Instacart products. And yeah, the bet is it will improve their shopping experience, they will come there more often, and they will sell more. And that's essentially their pitch for their partners. They have started testing this program in Q2, if I'm not mistaken. So if we go here in the earnings transcript, and if we go into the summary generated here, they're starting their caper carts since Q2 2024. And in Q3, they're actually giving some indication of how this program is doing. So how is caper progressing? The summary mentions it here, but then you get also ChatGPT to bring the parts in the earnings transcript where they talk about this caper program. So Fujisimo is the CEO. She's saying that they are broadening their deployment to more grocers, national, regional, and local. Best practice for every market segment. And it sounds like it's doing well. I'm quite surprised by how well it's doing. Personally, I would attribute this result more to the novelty effect and the fact that this is a new technology. Everybody is very keen on having AI in their business. So do grocery stores. But I mean, this is hardware. This is complex. This is a different ball game. Instacart is a tech company, and now they're getting into the realm of hardware, and hardware is hard. Manufacturing, maintenance of those high-tech devices, I think this is going to be quite costly, and if they're not careful, this could be very costly for their bottom line. And as a matter of fact, if we look at their financial statements, and if we look at the quarter view, we're going to see that their cash flow is actually decreasing over the past 3 quarters, and I suspect this is mainly because of their investment in this program. And it's not a slam dunk that this will be a successful program, right? This could have actually quite the reverse effect. Users using this cart might face some buggy situations with the tech. It might not recognize the right article. It might not recognize the article at all. And Instacart is not the first participant to try this, right? Amazon has tried this with Amazon Go a couple of years ago. The technology is definitely there, but users are showing that their habits are actually more sticky than what these big tech companies are thinking. Users tend to have a hard time to change their habits and then go with these high-tech experiences while shopping. In fact, Amazon, I think, shut down most of their Amazon Go locations, except the locations that are most symbolic. In San Francisco and Seattle, if I'm not mistaken, they kept those locations more for the symbolic reasons rather than profitability. That's essentially the industry that Instacart evolves in. The grocery delivery market is a crowded industry with DoorDash, Amazon, Walmart, Uber Eats all competing fiercely to capture market share. And it's something to keep in mind when you think about investing in Instacart. I mean, yes, they have big names already as part of their network, but it's something to keep in mind for the future. I mean, those big names, Costco, Kroger, all of them don't have exclusivity with Instacart. So they could be, in fact, they are working with multiple delivery systems. For them, it's just a numbers game. So whoever brings the demand, they will work with them. So these are not locked in agreements, and those partners could decide to leave at any time. So that's why for me, the moat of Instacart is not very strong. It's actually, for me, quite a weak moat. So if I had to evaluate it on their moat, for my thesis, they are below expectation. So let's now have a look at their financials. So if you navigate to the financial statements tab, the first view is this table that highlights the primary KPIs that people would look at when evaluating a company. And if you look at this KPI in particular, revenue growth, this is quite a commendable revenue growth, like 20% year over year. You're looking at doubling your revenue in 4 years. And that's quite good. This is quite a healthy growth for your revenue. If we have a look, this is quarter over quarter. If we go to the annual view, we can see that in 4 years, Instacart went from 200 million in revenue to 3 billion. That's a 15-fold increase. Of course, with the biggest increase happening during COVID, this was the time where everybody was locked down, so delivery services saw a boom, and Instacart was one of them. I personally used Instacart during that time, and I'm not one of those users that remained loyal, but a lot of them kept on being loyal. So revenue-wise, this is quite commendable, like a 15-fold in 4 years. That's excellent. And if we had to break it down into the different segments, so last year, 2 billion of that revenue came from transactions, and their advertising business actually brought in 800 million. This is a 30% of their revenue coming from advertising. So you can see that advertising is becoming a very important part of their revenue model. If we have a look now at the annual view, we can highlight something that's quite odd, that could seem worrisome. If you look at revenue, healthy 3 billion for a gross profit of 2.3 billion, this type of profit margin is quite unusual for a grocery retailer, but it's not unusual for tech companies. And that's why, to me, Instacart is really not in the grocery retail industry, but rather in the tech industry. So this is a 75% gross margin. So if we look here, 75%. They keep on increasing it, so they're doing a lot of good work to maintain their cost of doing business low. However, when you look at operating income and net income, it turns negative. And there is a reason for it. If we navigate to their free cash flow and their stock-based compensation, you can see that in 2023, they had a big expense in stock-based compensation. And I suspect that this is due to some payment of some executives that received some big stock-based compensations here. The reason why I don't think that this is a worrisome pattern is because if we go to the quarterly view, you can see that their stock-based compensation is back to normal, and they're controlling it much better in the following quarters. Overall, their revenue looks healthy. They're able to maintain that gross margin at 75%. If we now navigate to the quarterly view, every quarter, 75, 76, 74. And if you look at the Walmarts of the world and we look at their financial ratios, their profit margin is at 25%. This is pretty typical for a grocery retail store. But if you look at DoorDash, then their financial ratios are much higher, in the 50%. All right, and that's why for me, Instacart, again, definitely a tech company rather than a grocery retail company. In this quarterly view, we can see that the health of their financials is quite positive. So they're able to make money, their net income is positive, their free cash flow, they're able to generate free cash flow. And this is a testament that Instacart is able to turn their revenue into cold hard cash. So this is a really good sign. It's not, their free cash flow is not exploding, but it's still positive. So they're making money. Now, what's a bit more worrisome, and this is because of their AI investments, is that their cash reserves are actually decreasing quarter over quarter, and that's a bit more worrisome. So overall, for me, based on their financials, Instacart is well above my expectations. They're doing well. They're generating free cash flow. The only question mark here is, when are they going to see some return on their AI investments to justify the decrease in their cash in the bank, essentially. So now let's look at the leadership strategy. So if we navigate to the earnings transcript, and if we look at the summary that's provided by ChatGPT here, the leadership is very focused, and we can see that in their financial as a consequence of that, right? They're focused on improving the affordability of their items that they offer on their platform. And this is textbook what Costco does best, essentially providing the best prices to their customers to justify their membership fee. And this is what, rightfully so, I think Instacart is focusing on. Additionally, they're focusing on improving their ad offerings. So ad formats are just other types of products that they offer in their advertising catalog. You can buy different types of campaigns, and it's just another way to spend the ad budget of their partners, as well as they're entering partnership with restaurants. So they don't just do grocery retailers, but they're also entering the restaurant delivery service. And last but not least, of course, we covered this earlier in the video. They also have these projects, this AI project called Caper, which is a smart cart that they're testing out in a couple of locations. So overall, for me, the leadership strategies are spot on. They are focusing on the right projects, and let's see the return on their AI investments. Now, based on this analysis, for me, the risk is really around its weak moat and the competition in this space. Heavyweight like Amazon, Walmart, DoorDash are all expanding very aggressively in the grocery delivery market, and that puts a lot of pressure on Instacart's market share and margin in two ways. What's likely going to happen is a race to the bottom for their profit margin. There are two mechanisms that will enter in play. The first one is that they will need to reduce their prices, so they will need to focus on affordability to attract demand. They need to compete with other platforms, and their customers will go to whoever's cheapest. Right. The second one is they're likely going to witness a cost in paying out their shoppers, their drivers. Right. Drivers are also extremely price sensitive, so they want to make the most off of the hours that they work. So they will go to whichever platform pays them the most. So because both of these mechanisms, Instacart is likely going to see their profit margins get a bit more compressed and their financials put into a bit more pressure. The second risk that I see for Instacart is how well it can perform in an economic downturn. Right? Instacart hasn't been around for long enough to have navigated an economic downturn, and usually grocery delivery may be very well affected in a tighter economy. Right? Consumers will likely try to get their costs into control, so they can't justify anymore sitting at home and waiting to be delivered their groceries, so they're likely going to be back in store, which could explain some of the investments that they're doing with Caper carts, and they could get some return on those investments. But that's still unproven, and I think only time will tell how well they'll do in some of these economic downturn. So closing thoughts. So is Instacart worth investing? Well, the company has a lot going for it, right? They have strong revenue growth. They're doing the right investments and strategy, in my opinion. They have a high margin business, but there is a strong and non-negligible risk to me around their moat and the competition and the pressure that it will put on their profitability. So personally, I will not enter a position in Instacart at the moment. I'm going to wait and see how their investments in AI, Caper carts, advertising pan out in a couple more quarters, and then I'll revisit my thesis. That's a wrap. Thanks for watching, and don't forget to check out explainthistalk.com. And if you found this video helpful, drop a thumbs up and subscribe. See ya.